Welcome to Tax Depreciation 101. I'm David Chandler, a tax partner at Aldridge Borden in Montgomery, Alabama, and for the next few minutes I'm going to discuss the basics of tax depreciation. As you may know, tax depreciation is the means by which taxpayers are able to deduct the cost of purchasing assets that are used in their trade or business. So the more depreciation that can be taken, the lower the taxpayer's taxable income will be. There are generally two types of depreciable property: real property and personal property. Real property includes anything that is affixed to land. However, it does not include the land, which is not depreciable for tax purposes. Personal property is basically anything that is not real property, such as equipment, automobiles, and even land improvements. According to the IRS, personal property has a useful life of between 3 years and 20 years, and taxpayers are generally allowed to deduct the cost of the personal property over their useful life using an accelerated method such as double declining balance. The IRS useful lives, however, are not always indicative of actual useful lives. Although the IRS says furniture has a useful life of 7 years, I'm willing to bet you have a piece of office furniture you are still using that is much older than that. And I once had a client that could not believe we were depreciating his brand new airplane over only 5 years. If you're at all familiar with the tax rules, you know that every rule has an exception. There are definitely some exceptions to depreciating personal property over its useful life. The first exception is found in Internal Revenue Code Section 179 and allows a taxpayer to deduct up to $1 million of personal property in the year it is purchased. Commonly referred to by the code section, Section 179 expensing was originally a temporary economic stimulus provision, but it has become a permanent part of the tax depreciation rules. One important thing to keep in mind with Section 179 is that it is limited by the taxpayer's income, so it can't be used if the taxpayer has a loss during the current taxable year. The second exception is what has become known as bonus depreciation. Also an economic stimulus provision, bonus depreciation originally allowed taxpayers to deduct 50% of the cost of new personal property in the year it was purchased. Recently, Congress expanded the bonus depreciation rules, and now a taxpayer can deduct 100% of the cost of new or used personal property. Unlike Section 179, there are no limitations on the amount of bonus depreciation that can be taken, and a taxpayer can deduct bonus depreciation even when it has a current year net operating loss. So when should you use Section 179 versus bonus depreciation? This is one of those it depends situations, and you should always consult your tax advisor. But I will say that the cost of the personal property being purchased and the taxpayer's current and future income projections will definitely have an effect on this decision. Before we move on to real property, I do want to point out one exception to the 179 and bonus depreciation rules, and that is passenger automobiles. If a taxpayer purchases a passenger automobile, including a truck or van, which is a vehicle with a gross vehicle weight of less than 6,000 pounds, there are limitations on how much can be deducted each year. Be sure to keep those in mind. Now let's look at real property. There are two types of real property. Residential rental property, which includes rental houses, apartments, and vacation homes, are depreciated using the straight line method over 27.5 years. Non-residential real property, such as office buildings and commercial rental property, are depreciated using the straight line method over 39 years. Since real property has depreciable lives greater than 20 years, it generally doesn't qualify for Section 179 or bonus depreciation. Recently, however, Congress expanded the taxpayer's ability to use 179 or bonus depreciation for the following improvements to non-residential real property. The first is called qualified improvement property. This is basically any improvement to a building's interior except for enlargement of the building, any escalator or elevator improvements, or any internal structural framework improvements. The second case where you can use 179 or bonus is for roofs, HVAC, fire protection systems, alarm systems, and security systems. So based on the above, what are some strategic moves that a taxpayer might want to consider here at year end? Well, one strategy may be to try and shorten the depreciable lives of assets by converting real property into personal property and deducting those related costs sooner. This can be accomplished by engaging an engineering firm to perform what we call a cost segregation study on the real property. This study will separate personal property from real property and allow the personal property to be depreciated much quicker. These cost segregation studies can be done even if the building was placed in service in an earlier year. They are a great tool for reducing taxes and increasing cash flow. A second strategy might be to accelerate the purchase of depreciable personal property into the current year, especially when the current year income is unusually high. Even property placed in service in December can be fully depreciated under 179 or bonus depreciation. In addition, it is okay if the asset purchased is paid for next year, just as long as it is placed in service in the current year. However, don't forget my favorite saying, don't let the tax tail wag the business dog. If you don't need that new piece of equipment, don't purchase it just to get the write-off. Unfortunately, that is all the time we have today. If you've made it this far, I hope the above information was helpful, and it is easy to see why tax depreciation can be an important tool when looking at year-end tax planning. Please feel free to contact me or one of my partners if we can be of any assistance. Thank you.